Hello, everyone, and welcome along to this live webinar. And today we have a very special webinar, a panel of experts. We're going to discuss 2025, what we had in the market. It's a very interesting year, and also speak ahead about 2026 with the tips from our experts today. So we have John Noble, the property investor and the tax expert. Steve Doran, property investor, entrepreneur, mentor, writer, many things. Hi, Steve. And of course, Harvey from Harvey Growth Properties, property investor, mentor, developer. Um, and perhaps, you know what, I will let you introduce yourself. If you can do it like quickly, one or two, like, I don't know, two, three sentences, and then we will present the agenda for today and we will start. So,
Sure, I'll start. My name's John Noble. I own an accountancy firm that specializes in property, and we show people how to start a business, scale it up, and invest tax efficiently into long-term cash flowing, appreciating assets, which is property.
amazing. Steve?
Yeah, I know you like to keep things very brief, Avram, so I'll keep it nice and concise. If I take you right back to years ago when I first started out in no, I'm just kidding. My name's Steve Doran. Been investing for the last 20 years. We've got a collective of different property businesses, so deal packaging. We've got a finance brokerage where we help investors with lending, rent to rent business. And so we're a big believer in having property businesses that feed property investments. And so in terms of buying, we buy commercial, HMO, short-term lets, that sort of property, and do everything in between, really, flipping and try not to do too much flopping. And that's about it, really.
Okay, good. And Harvey?
Hi everyone, I'm Harvey. I am an AI remote property investor. Last 2 years, I've been really digging into, well, the last 10 years I have, but I've got an AI agency now where we set up AI automations for property people specifically. Really excited about that side of things. The automation is absolutely wild and getting better and better and blowing my mind day by day. Really excited about it. Just trying to hire more and more people to do the setup for me at the moment because it's just going so quick and I've got so many ideas. But I think the people that dive into this. We're in a unique little window of opportunity, like when Bitcoin first come out, like when London properties was really cheap. I think people that ride this wave nice and early have got a higher probability of really benefiting off the back end. And very much like Steve, I believe in active income into passive income and keeping them income streams within the same ecosystem of what I'm doing. So why my AI business is in property is because I'm a property investor. Also, I do a little bit of sourcing also. We've got an AI machine that's sourcing property deals fantastically, negotiating for us. Doing a little bit of flipping recently and got some buy-to-lets, HMOs and everything kind of in between also.
Amazing. And I present also myself. So Avi, I'm co-founder and CEO at Lendlord. Lendlord is a platform for property investors and landlords all around the UK. We help landlords and property investors to manage their existing portfolios, but also to grow it with access to sourcing tools, deal analysis, and also access to digital finance, which can help you grow your portfolio easily. And of course, the platform is like AI is integrated into the platform. And let's just share the agenda for today. Can you see the screen?
Yep.
Okay. So I think we passed the introduction and welcome section. So we'll start with discussing the 2025 year, some insights, perhaps, you know, a few words from each of you, of our experts. Then we'll discuss the predictions of 2026 and also some advice from you to investors for 2026 in terms of best strategies. And perhaps John is here, so perhaps you can also speak about you know, the budget and the impact of that. And we are also have Making Tax Digital coming in this year for some of the landlords. Like I think it's for individuals over 50K, but correct me if I'm wrong. Landlord will support, by the way, Making Tax Digital, so you would be able to report your you file your tax returns in a quarterly basis through Landlord. And then we'll have a panel of questions and answers and some closing remarks. We will try to do it in less than 1 hour, but We'll see if we can, when we need more time, perhaps we can do it. Few things, as always, we are running a promotion for our premium plan. I will share the details in the chat. And also, there are some great new features on Lendlord. So I will give you just a brief overview about it. So first, we changed a bit the deal analyzer. So now you have target metrics. So instantly, let's say that I'm on. So first, you need to download the Chrome extension. If you are on a Rightmove listing page, click on the Lendlord Chrome extension. Then just decide which strategy you want to analyze. Let's choose BRR. And then the platform extracts all the information from this Rightmove listing. Using an AI, it will also try to estimate the refurb costs and the GDV. And instantly we'll see the metrics and how it's above or below your targets, which you can always edit from this side bar. Then you can play a bit with the parameters of purchase price, refurb cost, GDV, and expected monthly rent. And you can see the metrics for the short term, for the long term, and you can also run best case scenarios, worst case scenario, and more as we had before. We integrated another AI chat for refurb costs. So it's basically answering several questions about the property. The bot already took some information from the Rightmove that we extract the data from. So it will also include data that he already extracted and analyzed. And then after a few answers, you will get the breakdown of the refurb with estimated number. It's still a beta version, so we'd like to get your feedback on the chatbot of Lendlord. So feel free to comment and ask also for new features and new enhancements. Okay, so this webinar is not on the Lendlord platform. It's mainly on 2026 and summarize 2025. So let's start with the agenda for today. If we have questions, we will take them in the end. So the first topic is 2025. So we had a very interesting year, like with some uncertainty. We had the budget in November and many rumors before the budget. Eventually, we saw that many things were not included in the budget, but there are things that are there, and there are things that basically have not changed, but there is an impact because they haven't changed. So let's pick your brain, and perhaps each of you, if you can summarize 2025 for you, how you basically what were the main things for you as a property investor, and what you are going to take for 2026. So who wants to start?
I'll start.
Okay.
So we, as an accountancy firm owner, it's a privileged position to be able to look at hundreds of businesses investing in property. Cash flow, we need to be investing for cash flow from day one. So we invest for the cash flow and we're holding for the long-term appreciation. They are the two key metrics. We've seen lots of the money moving from the south to the north. And since COVID and people are now working from home, people are being paid more money. The properties in the north, they're depressed. To actually purchase those properties is cheaper than if you were to build them. They're essentially on sale. Because interest rates went through the roof years ago with Liz Truss coming in, and now they are slowly coming down and there's confidence coming back into the market. And that's the key thing I saw in 2025. The confidence of the person who was thinking about investing, they're now taking the plunge. And when we see that happening, prices start to go up in the following years. So you get the seasoned investors who are always purchasing. They like it when there's a downturn because things are on sale. We are seeing, as an accountancy firm, that people who were thinking about it are now getting back into the market. And I think that's a really key metric because that will show us what will happen in the next 3 or 4 years because there's going to be much higher competition for those good yielding properties, family homes, HMOs, the foundation of any serious portfolio.
Okay, interesting. Harvey, over to you.
Yeah, the funny thing last year is again so much gets driven by sentiment as well, and like it's just that's more of a driver of the market than actually the fundamentals that's behind it. But again, because there's loads of bad news, you see loads of I've seen more landlords exit the market than I've ever seen, and I've seen the rents rise quicker than I've ever seen. And if I balance my portfolio, my rents have risen a lot more than the interest rates rose before previously. So I'm in a net positive position than I was before the rates started rising, and now they're coming back down again as well. I think there's a few. I think one of the things we got to let go of, there was an old rule years ago of like only invest within an hour from where you live. I broke that rule about a decade ago. But now I still only picked one location. I'm investing anywhere in the UK now. I just bought a property that I've not viewed. I've not been there, don't know anything about the area whatsoever. But because of AI now, I analyzed it instantly. Because of platforms like Lendlord, I had decisions on where I was going to lend with it. And Lendlord was very friendly with me as well, helping me fund and do this deal as a flip. So I'm seeing there's loads of these little Goldilocks zones. And what I mean by Goldilocks zones is where everything is just right. You can still buy fairly cheap, there's capital growth, and there's still yields in the property. But you have them Goldilocks zones, if you live anywhere in around London, just don't work unless you're a good developer and know to do HMOs and larger developments and stuff like that, or something that's higher cash flow. But the higher cash flows often come with exchange of higher sort of inputs, basically, and a bit more complexity of management. Yeah, I'm still buying loads of not loads. I wish I could be buying more, but I'm still buying some fundamental stuff in little like Goldilocks zones, like places like Yorkshire. We just done a flip in Yorkshire, what we bought for 170k. Just bought, as I said, in Wales for 96k. And these areas have got all the fundamentals of growth and yield and low price. I don't think it's going to stay around forever, though. I think it's catching up as the jobs are spreading more and more online. Yeah, but it's going to be an interesting time with the budget. The budget wasn't as bad as it. I didn't pay attention to the news I did all last year because I said too much is sentiment led, and I think as John was alluding to, like if proper investors just figure out how to invest within the environment they're in, and you just adjust. And people that like amateur and not being mean. I know it sounds like you're being arrogant here, but amateur investors always look, oh, is the market going to dip? Should I wait for this? And they sit on their hands. You've got to make the opportunity work in all the different seasons. And I've got a thing that I call an all-weather portfolio. You need to be able to weather the storms when they come. Any long-term investor will weather storms, and sometimes it's about not way I looked at it over the last couple of years. If it cash flows here, I'm pretty sure the rates are going to come down. So when the rates come down, it's going to cash flow even stronger. So as long as I'm buying strong, sturdy assets, then that's the way forward. But I think we've got going forward, we've got a small window of opportunity as everybody starts flooding back in. The rates are under 4% again. The news is talking about that. So, but there's pros with that. The capital growth will go up a little bit faster as that happens as well. So there's always a way to sort of capitalize as long as you navigate correctly and you protect your downsides.
Yeah, Harvey, by the way, in terms of the cash flow, like we actually we have a great feature, the stress test of your portfolio. We launched it in COVID when people started to be worried about tenants stop paying rents or like they were like rent reliefs and things like that. So basically, we have the stress test feature, and I'm encouraging everyone to test it because then you can see um, the basically the minimum margins you actually have on your cash flow. And then as you said, that basically when rates will go down, we'll be able to remortgage, or rents go high, then it just started to grow. I think like the starting point is good, and technology, I think for me, 2025, it was a great year. And you mentioned AI technology started to evolve. Much more tools are now available for property investors. And I think the key is basically to take those AI tools and make them more relevant to you, the vertical that you are working on. So what we do at Lendlord, we took the AI from, like, we use APIs for ChatGPT, Anthropic, Claude, and we train them on the property industry. And basically we use information about the information that we also get from AI about properties and about deals that been analyzed, and basically make it much better and much more proprietary for property investors. Um, so I think technology for me, like the involvement of AI in 2025 is a key, and we will see it, I think, continue to grow in 2026. This is my
Y-
take.
Yeah, I agree with that. I think a lot of people always look at how can you earn more, but efficiencies earn more as well. So if you can make your systems and everything you're doing more efficient, you squeeze more out of your pound anyway. So you don't always have to earn more pounds to earn more money. So last year we set up loads of AI agents to do a lot of the negotiation for us on lots of deals. So the efficiency of me not spending lots more time or hiring people actually earned me more money out of these deals than they would have before. And it's just improving. Obviously, with I'm watching Lendlord as it grows with this. And the good thing with Lendlord, the thing is, a lot of people just go on ChatGPT and just put in a generic prompt saying, "Hey, ChatGPT, can you do this?" And you can't. You need to guardrail it or use specifically trained ones like Lendlord to give you specific information. Otherwise, you're going to get a load of kind of generic slop, unfortunately.
Yes, and like before we go to Steve, like one thing is that instead of taking the data into ChatGPT, when you work on Landlord, you have already the data there, so you just need to ask the question, and I think this is and also of course the training and the learning of the model. All right, over to you, Steve. 2025 for you. How was it?
2025 for me, I'll reiterate a point that John and Harvey both said, and that's cash flow. I think that's always got to be paramount, right? We all love, let's not say like, we all love property for the fact that we're banking on capital growth and that's where we're going to create wealth, but we're living on cash flow. And equally, we need to make sure that there's enough headroom in that to have was it all weather portfolio, which I like the sound of that because you do get all weathers in the property world, right? And so realistically, if the interest rates jump up, you want to know that you're still making profit, not even just covering bills, but you want to still be making profit. And so what do we see over the last year? Yes, some upset from things like the budget, things that slowed the market down, which to use Harvey's phrase, Harvey said it first before anyone trolls me, the amateur investors will be maybe dissuaded by or put off by, and it holds them out of the market. But the pro investors, well, who's the best investor on the planet? That would be Warren Buffett, right? Might not be property, but best investor said to be fearful when others are greedy and greedy when others are fearful. And look at, if you zoom out and forget about what the papers say, because we all know the papers are very good at controlling the narrative and steering the people and spreading fear and excitement at the same time. But if we step away from that and zoom out, well, what's actually happening? At the moment, there's a massive war on personal private name landlords. There was an incredibly handsome gentleman who's been on social media for a while saying to buy a property in a limited company if it's for investment purposes. You may already follow me. If you don't, you probably should. Everyone's like, no, that was me. That was me. I'm that, all of us. And the reason is the writing's on the wall. Since last year, it was pretty much put out that we're coming for you. And the problem is you're almost a sitting duck. Now, I'm not saying that I always knew that. It was the thing that we did back in the day. We bought property in our personal name, and now we are sitting ducks. So English Private Landlord Survey 2024, which is the most recent one, 92% of landlords own in their personal name. That's a whopping amount. It's a very easy target to go, yeah, we're going to put, because it's so illiquid, it's so hard to move across without then triggering other tax events. So easy target. Last year, 70% of people bought in a limited company. So people are moving towards that. Now, limited companies, without getting into the nuts and bolts of it, are going to be so much more tax efficient, so many more reasons. And so what's happening simultaneously? Well, you've got a lot of private landlords who are going, and we sell properties, right? So what do we sell a lot of HMOs as an example. Nothing wrong with the HMOs, great deals, cash flow well, personal name landlord, screw this, I'm getting rinsed on tax now because of Section 24 and whatever else. My property's gone up a lot in value, it's time for me to cash out. Then you've got very big people purchasing Lloyd's Bank, Blackstone, BlackRock's indirectly involved in UK property. Lloyd's Living, should I say, which is a branch off of Lloyd's Bank. I mean, they were originally mortgaging people's properties. Now they're going, well, actually, we want in. These companies are spending billions in the UK property market because basic economics, not enough supply, way too much demand. So it's a little bit almost of a squeezing the little guys out and big guys are coming in. So if you, like I said, zoom out, good or bad investment or a great place to be. And even for those that aren't in a position to buy, you can either A, buy creatively, or B, you can still make a lot of money from property just by dealing with, you sell a property, you charge a percentage. It's great. You let a property, you charge a management fee. Great. You do rent to rent. There's so many opportunities around that to create cash. So over the last year, I think I've seen the fearful leave, maybe the frustrated leave. So people are worried about renters reform, which actually, when you drill into it, in my opinion, isn't really a big deal. There's not much in there that would affect the way that I operate. People are worried about tax changes, which if you are in limited company, not really a big deal. And so now is an opportune time to buy. We are very aggressively, or I personally am very aggressively buying this quarter. Very aggressively. I mean, within the last, just this week, 5 different offers, 5 different properties. And Harvey made a key point. What I love right now is we're not restricted to this hour drive from home. My original property is like 1-2 roads away, 1-3 roads away. Now, just offered on a property in Cumbria, offered on a property in Darlington, offered in a property in London, offered in a property in Peterborough, Durham, or all over the place. It just doesn't matter, and it's great because with technology, with systems, with feet on the ground in different places, we can do so much more than ever before. So. I guess I'll wrap with don't wait to buy houses and wait. We all know that that's why we're here. I don't want to teach anyone to suck eggs, but for me, when other people are hesitating, is arguably the time to double down and get involved in whichever way you can. There's so many ways to be involved.
Okay, good stuff, and very interesting. I think like now I would want to understand, perhaps like to drill down on like which strategies perhaps we should adopt. But perhaps before, if like quick, like this is the next topic is predictions for 2026. So perhaps like very short and briefly, if you can, you know, perhaps on one point, it can be related to anything. What is basically your prediction for 2026 in terms of property market? It could be, house prices, new reforms from the government, landlords going out, landlords going in. Like you already touched some of the points, but it's interesting, like focused on 2026. If we take now the time 12 months ahead where we are at and like freestyle. So perhaps John, you can start.
Sure. Okay. My key prediction is rents are going to absolutely skyrocket. We've already seen that in the last 6 months. Every property I own, I have alerts set up for 0.5 miles, and the properties that were renting 6 months ago, there's an extra 100, 150 pounds on those rents now. People who purchase property in their own name did the correct thing at that time, but the tax landscape has changed. And those people are doing one of two things. They are either releasing those properties and enjoying the cash because they've been landlords for a very long time, or they're now continuing to purchase in a limited company. The structure is absolutely everything. You need to be able to reclaim your full finance costs because your finance costs, your mortgage interest, which is fully tax deductible, cannot be fully claimed in your own name. And if you are building a portfolio in your own name, rents go up, you have other sources of income, you're paying tax on a phantom profit. So my prediction, and it's already started happening, is those people who all have those properties in their own name, as Steve said, it's the majority, they will sell up. There will be less supply. That's going to push rents up. The renters reform bill isn't a major thing. It's noise, in my opinion, but it scares people. And when it scares people, there's less supply. So I think there's going to be many, many, many fewer properties. Even if we had net migration as it is, there'd be fewer properties on the market. But rents are going to go extremely high. And this is why I'm going to focus on very simple family homes, what would be seen deemed as less risky previously because there was less cash flowing them. That's what I'm focusing on. 2 and 3 bed, 4 bed, family homes, adding value, making money when you purchase, doing a refurb, cosmetic, but you're replacing like for like kitchens, bathrooms, damp work, so you've got minimum repairs, putting it on the market, leaving it for decades, recycling the money. That's the game plan because I think rents are going to go up a lot.
Okay. And I think we already started to see some evidence for that, you know, in terms of rent prices. Okay. Great. Harvey?
Yeah, I think John covered quite a lot of that of my thoughts. But yeah, I do agree. I agree with John. So, but on, I think the foundation of any property, you mentioned strategy earlier on, Avram, so I might be jumping ahead, is finding good property deals. No matter what you do, you have to find a good property deal. Like whether you're doing HMOs, rent to rents, buy to lets, service accommodation, it all starts with the skill of finding good deals. I think everybody should be adapting. My prediction for 2026, I don't know how quick it's going to come, but I think the people that are going to not embracing technology, not embracing what Steve is doing and John is doing, look at wider locations and not breaking the old trend, are very rapidly going to be left behind and going to struggle to break into it. So I think we've got a window of maybe 1 to 5 years where it's going to get harder. That gap is just going to widen and widen. So if you don't grab a little part of that gap right now, then like getting into that in the future could be harder. I don't know for certain. Obviously, it's not. Don't bet your house on these predictions, but I can see that widening, and I can see it getting harder. And I think AI, as I said, is going to play such a massive part across all of it. Like, believe it or not, when I first started property investing, I didn't even have a laptop. I used to look in the local gazette in the middle of the pages to look for properties. And just think of it like this: if I carried on trying to source my properties looking in the local gazette, do you think I would have stayed competitive? And I wouldn't have, obviously. So everything onto Rightmove and things like that. Now we're going into a new era of AI agents working with us and doing stuff for us. And I see so many people. I'm doing webinars on this every week, and I ask at the start, who's already using this in your business? And I'd say 90% of people are not. And I'm like, wow, it's not just for your business, for your whole life in general. You want to be getting the front edge of this. It's a really big opportunistic time. But I can see a massive shift. I agree with John, and I agree with Steve. I think more landlords are hesitant because of this renters reform. I don't think it's as bad as it seems. And I think if you do it, I have for years, I've just got rent insurance. It's simple. It costs 20 pounds. When you've got quite a lot of in tenants, initially I used to say, I'm not paying at the time when I first started paying rent insurance, I must have had maybe 20 or 30 tenants. And I was like, I'm not paying £20 times 30 per month. No, thank you, kind of thing. But every year I had some sort of problem that equaled or more the amount I pay in rent insurance, but also just the headache, the stress, the opportunity cost of me having to deal with it. Having rent insurance is just like having a bouncer on the door of a nightclub. Most tenants don't even challenge it. If you send a letter out to a tenant saying, "Hey, I want my property back. Here's a Section 21 or a Section 8 or whatever it's going to be when the laws change," a lot of tenants think, "Yeah, okay, I can play the game with you." And even if the landlord sends it or a letting agent sends it, where if that gets sent from a lawyer, like a bouncer on the door, he might be a big teddy bear, but you just don't test it. And like when it comes from a lawyer, people just don't test it. So I hardly ever get any problems with it. And the odd occasion they do, just pass it over to the lawyers, they deal with it, and it goes from there. So I think as long as you've got rent insurance, I don't know what everybody thinks about rent insurance. I know you're involved with insurers as well, Avram. Don't know if there's going to be a premium on that with these new changes, but I think there's going to be a lot more fear still. I think house prices will go up. I think a lot of home buyers will buy a bit more because the rates are coming down. So I think we're going to get a bit of capital growth. We're going to get rental growth and capital growth at the same time. I think it's going to get increasingly a little bit more difficult to buy good deals, but I think it get more competitive to buy. But there'll be more growth. There'll be more rental yields. There'll be the yields are going to go up in both ways. Rates coming down and rents are going up. So that's my thoughts on going forward.
Very good. All right. Over to you, Steve. Something that we have not heard about as of yet is location as well. Because it's like, I think it's also important to, I don't know if like what you see now in London and M25 is the same of what we see in the north or in the south or the east. So
Every area, I think, yeah, every area operates differently. I think location is going to depend on strategy, short term and long term, what you're doing. So before you bury London, I've got two offers in on London properties. So just before we,
Yeah, can I jump in as well there? I've never seen so much opportunity for buying cheap properties in London in my whole time. There's massive opportunity for buying in London at the moment, not for rental, but for flips or other creative stuff. The discount, because the growth hasn't been like growth goes in reverse sort of thing. The more growth there is, the less discount you get. The less growth there is, the more discount you get. And London's stalled for a while, so there's massive discounts there. Sorry, Steve, to jump in there.
I know, well, you're completely right, but I'll break down these two properties, right? One of them is a property that's been on for a couple of years, struggled to sell, went on at 2.5. I won't give the full details because I'm trying to negotiate a price right now, but went on for 2.5. It's dropped and it's dropped and it's dropped. I'm hoping to get it for roughly half of that. That's a ginormous saving, ginormous. But that's now being sat and it's costing and it's frustrating
So
the person who owns.
sorry for jumping. So basically, you buy because you think it's going to rise again, like the price will go
This one
up.
needs, yeah, this one needs love and it's not getting love. And if it had that love and if the owner could be bothered, the owner, without divulging someone's too much detail, is a investment bank. I think they're very much just city involved, not property involved. Put it on, left it on. Agents probably not too proactive. That suits me, fantastic. And now the property over time has been cold, left empty, and it's just deteriorating. But it's easy stuff for someone to come in and fix up, right? Most people that are spending in that range don't want to move into a fixer-upper. Most people that spend in that range want to move into a property that's ready to go. The other property is a mixed use, and mixed uses and commercial is something I'm doing more of recently. Big reason for that is just the additional rate. Stamp duty is an absolute killer. So I've got an offer in at a mixed use. It's 725, and to contextualize it, if that were a residential property, the stamp duty on that's going to be over £62,000. As a mixed use property, it's about 24. You're talking about £38,000 saving on the capital that needs to go up front just on the stamp duty, but still 3 flats above a shop. So you got mixed revenue, you got potential capital allowance claims, so potential tax claim on the shop, but you've also got still decent yield. So we're still cash flowing well. So more commercial, more mixed use than ever for me. But different deals, different areas. I'm not, well, you wouldn't really go and try and get a service accommodation in London, as in it's planning aside, because you can't, but in those areas where the property value is quite high, the nightly rates in the areas are still quite competitive in a lot of areas. Whereas you go to the north, where we've got one at the moment being refurbed in a place called Barnard Castle, quite far in the northeast. There, your nightly rate is still quite high in comparison to the property. We paid 165 for the property. After all said and done, it will cash flow about £2,000 a month after the expenses. So area, I think it depends on the strategy. You've got to have these tools to do the due diligence. I completely agree with that. And you've got to have the education to be able to interpret the data that's coming back to you. You've got to have the support to sound it out, to move forward and in whatever field you're going, whether it's HMO. You can go and get an HMO in an area with no demand or not understand planning. You can get tripped up quite badly. You get it in the right area and you could be laughing your way to the bank, so to speak. And the same goes for the SA. So I think it's area dependent and strategy dependent. Those two things have to match. To echo, I know Avaram, you challenged me, Avaram, because the shortest training that I ever deliver is 2 days, and you generally give me about 2 minutes to answer a question. And you guys will notice at the beginning of everything, so just give me a very short answer, very quick, guys, very, very quick. It's basically like, shut up. Give me something, but not too much. I'll echo one point on the renters reform because I think that's spreading a lot of fear into investors at the minute. I deliver training every other day. It comes up without fail on webinars and trainings. But when you drill down, most people don't really know what the difference is for them. It's just that they've seen the headline and they've seen that people are leaving. It doesn't really change anything I'm doing. For me, with buy to lets, I've never had a problem with taking pets in, as an example. For me, with if a tenant wants to leave and they're midway through a 12-month tenancy, I've never had a problem saying, just give me a month's notice, we'll list the property, we'll find someone. Why would I hold someone to ransom? So switching to rolling, which those that don't know, 1st of May, doesn't matter what tenancy you got in place, that's done. You're going straight over to a rolling monthly contract. So that sort of stuff just doesn't bother me. Section 21, over hundreds and hundreds of tenants over the years, I've never ever served a Section 21, ever. I've never asked someone to leave a property for no reason. Why would you? You know, what's the so that sort of stuff just doesn't, it's neither here nor there for me. So that stuff's not, but it will carry the people. It will take Harvey's words, the amateur investors away. I'm going to keep reminding everyone Harvey's, but everyone here is not amateur investors, by the way. But the key principles of property stay the same, right? Number one, try and buy at the best possible price. Now is an opportune time to do that. You've got great tools to find motivated sellers. You got the ability to find properties that are sat that people, if they're in a position where they very motivated to sell, you can negotiate a good price. So buy at the right price. Number two, add in value, however you're going to do that, put in the right lease in, put in a refurb on, whatever it might be. And number three for me is always getting the highest return per square foot. That's where your HMOs, your short-term lets, that sort of stuff comes into its own, because you're now taking the same property that might not make the same return doing something else and getting more from it. So that would be my simplified version of what I'd look for in a property, because I cover a lot of areas, a lot of strategies, but the principles are the same. Buy below market value, add value to the property, get the highest return per square foot.
And also basically this is like the BRR strategy, I would say, no? Like basically improve like buy, improve, and then keep it for the
Correct, yeah, and BRR, if and when we're refinancing, we're not always refinancing, but we are always buying at the price, always doing something to bump the value. Usually the way that we operate the property, and getting the highest return. Sometimes, like the one I mentioned in Barnard Castle, we're doing a refurb, we're going to try and pull the bulk of our cash back out. And so yeah, BRR, and fine. You made it a simpler way to put it than me, Avaram. Are you happy?
Yeah, of course. One small thing you mentioned, the renters right act and the change of tenancies. So on Landlord now we do have support for different tenancy agreements. So we have the previous, but it's still like I think valid until May, the short hold tenancy. But now we have a new tenancy template that should be based on the new Renters Right Act. And we also added the now HMO tenancy agreement, and we will add more agreements. So if you maintain your tenants and your prospect tenants on Landlord, you can generate the tenancy agreement quite quickly, and you can also send it for signatures. So on our premium plan, you can send any document for auto signature on the My Document section. But of course, if you also generate a tenancy agreement to your tenants, you can also customize the template, playing with the sections, change text, remove sections, add sections, and then you can basically keep this template for your next tenancy generations. Yeah, you can just click on send for signature, and then you will get something like a DocuSign, so you can place the signatures and send it to your tenants to sign. Okay, so this is this quickly, and also people ask, so in order to apply the coupon code, go to your settings page or click on the link that I shared on the chat. Click on the account information, on plan details, click upgrade, and then just put the coupon code panel 26 and click apply coupon, and you will get our premium plans with 50% off during this webinar time. Okay, so in terms of the agenda, let's see if we have more things to cover before. Yeah, practical advice. I think you gave already practical advice, so perhaps we can start with the questions and answers session. So, okay, so for our great audience, you can raise your hand and then we will give you the permission to talk and ask your question, or just write the question on the chat and we will pick it up from there. I think we already have some questions. Let me see. Okay, so yeah, Mahesh asked, I have two ex-tenants who have defaulted on the rent, and one of them got court decision but cannot locate to recover quite a lot of loss. Okay, I think it's more like a comment, if I'm not mistaken. If it's a question,
I think it's a question. I'm guessing, yeah, I'm guessing it's a question. I think there's firms that you can assign that will go out and find. So if I'm reading this right, and I could be wrong, tenants defaulted on the rent. It's gone to court, won the decision. They've been evicted from the property. They've now probably got a substantial amount of rent arrears owing to,
okay.
was it Mahash? But Mahash is struggling to actually find where the hell they've gone, right? Because these tenants will, or Mahesh, they try and disappear into the night because they don't want to pay you back. There are firms that you can assign that will go and pursue that debt for you. I recommend using those. They will usually take some share of that money, but a percentage of something is better than 100% of nothing. So I'd recommend probably going down that route.
I think there is a company property action, I think, I'm on that for of Paul Champolina. I don't know.
Landlord action, yeah. Landlord action are more for, I think, supporting people through the court process.
Okay.
I'm not sure if they've got a recovery arm as well. They might do. They might do. Well, they certainly could probably point you in the right direction.
Yeah, for sure. Okay, next question. Next question. Panel thoughts on social housing strategy in 2026? Someone?
Yeah, so lots of our clients are moving to that model. It bridges the gap between residential and commercial because you get the FRI lease part of it, so you can hand over a property for 5 years. Councils do it. There's social housing providers, there's charities, so there's lots of ways of doing it. There's additional risk, of course, and in all of those terms, and you have to think about the insurance and the mortgage side of this too. Can they cancel it and hand your property back within 2 months? Because if that is the case, then it isn't actually a 5-year term. So you would look at, if you were going down that route, I would specifically look at a property that you could purchase in cash cheaply. So you maybe get a 10 or 15,000 pound discount, refurb it to the spec you're happy with to hand it over for a 5-year contract, but always have an exit strategy. So if it does come back to you, you know, in that area, you can just place it onto the rental market and it's cash flowing from day one. It's very, very popular now and it does work, but it inherently has more risk because there's more variables to it.
Okay, thanks, John. Next question. What are the top 3 criterias to look out for a Goldilocks property? Yeah.
That's for Harvey.
Yeah, I'm guessing that's for Harvey. Did you say Goldilocks earlier?
Yeah, Goldilocks zones, just right, isn't it? Like your porridge, just not too hot, not too thick and lumpy. Everything's got yeah, mate. Basically, the main fundamentals you've got to look out for, and with strategy, going back to strategy, I think the main fundamentals you have to look out for is your skill level, your experience and knowledge level, and not just like book knowledge, as in I've watched a few YouTube videos and read a book, as in like experience, and your skill levels. Just because I know this sounds harsh, but not everybody can do everything. What a bugbear of mine is when you typically see guys in Lamborghinis saying, "If I can do it, so can you." Guys in the Rolls Royces don't typically say that because I couldn't do what Steve does. I hold my hands up. He's more talented than I am. You know, I'm impressed with what he does and what he takes on like as a capacity because that's the thing that a lot of people underestimate. How much capacity have you got? What is your skill levels? Like there is 40% of kids try out football every year, but only yet 500 people make it to the Premiership each year. And it's not due to them giving effort, trying, having the right mindset. It sometimes caps out on skill. So I like assessing people and doing assessments. So let's work backwards. Just see what your time is like, how much money you've got. What is your confidence like? What's your appetite to risk? Do you overthink things or can you just dive in and take action anyway? You've got to take an assessment and then reverse backwards. Every strategy works in different parts of the country. It's just figuring out what works for you and your circumstances at the time kind of thing. So I think the Goldilocks strategies and the popular ones are the ones that work with you, like, and what works with your profile. So you just want to ask yourself those core fundamental questions. The main fundamental ones I ask when I work with people is how much money you got, what is your time like, what is your network like, what's your experience like, and what is your confidence like of like taking action. And then you take buy-to-lets, I call it a delta matrix. A delta is a triangle in ancient Latin. Buy-to-lets at the bottom and developments at the top. The higher you go up, if you score yourself 1 to 10 on all those questions, the closer you are to 10, the quicker you can elevate up there, you know? So, and if you're lower, it's just a case of building up. But all the strategies work at the moment in just different locations for different people and different skill sets.
Yeah.
It's actually one of the most difficult things, right? People ask the question, you guys must get as well. If I got 50 grand, what should I do? And you're like, well, I would have been it because there's so much more to that. What's your goal? How much time do you have available? Where do you want to be? Is this a cash flow play? Is it capital play? Is it a legacy play? So it's trying to align the action with the goal and with the resources, those two things for sure.
Okay, next question. What is your advice for new investors looking to build a portfolio in a limited company, but have a buy-to-let in their personal name? Do they sell up or refinance to release as much as possible?
Sure, I can take this one. So everything going forward needs to be in a limited company. And the first thing you need to do is look at where your money is coming from. So it's either you're already taxed money, you have retained earnings in a company, or you have a group set up. The first thing you do with that scenario is look at how much tax you're paying. If you're a basic rate taxpayer or a higher rate taxpayer or an additional rate taxpayer, it's a different, completely different plan. How much of a capital gain is there? Is also because a lot of the time it's better to let that property go if it makes sense and then redeploy the capital in a limited company. So in that scenario, you'd sell it, you'd pay your capital gain if there is any, you take that capital, introduce it to your limited company as a director's loan. That money's owed back to you at any point, so it's super flexible, and you invest through the company. Sometimes there's a massive capital gain, so you wouldn't want to do that. It all depends on your long-term plan. Sometimes people will reduce their personal income to bring them back down to a basic rate taxpayer because you get a 20% tax credit anyway. So if you get a 20% tax credit and you're a basic rate taxpayer, it's okay. It's when you become a higher rate taxpayer and you've got this large interest to pay on properties in your own name, it becomes an issue. So first of all, look at what the capital gain would be if you sold it. Is there any sentimental value? There shouldn't be, because if it's an investment, it should be a spreadsheet exercise. And you could potentially leave it in your own name and carry on investing through the limited company, or you sell it. They're the most two common answers. Very rarely does it make sense to sell it to your own company because you're going to trigger a stamp duty surcharge. And if you're purchasing property in a limited company, you've got that 5% additional surcharge there. So you don't want to sell it to yourself. It's a dry tax charge and it very rarely makes sense.
Yeah, I just add something to that, and we talked about this, John, because that's what made me think about it. Is obviously think if you've got a spouse as well, you know, so you might be a high rate taxpayer, but your partner might not be, so you might be able to spread between. Well, I often come across people that they want to start earning more money, so their wife or their husband can stay. One of them can stay at home and be more hands on with the kids. So you can consider you both of your tax bands between the two of you as well. So that's another.
You can use a declaration of trust for that, which is very effective.
But it's not, similar to what you're saying with the strategies. There's no one cap. Everybody says, should I do it this way? You've just got to look at your end goals, your circumstances, and then you've got to cross analysis it. Like John was saying, no sentiment. You just got to run the numbers on this and then see what works best, kind of thing. And that's why I would get advice from the proper accountant. You've got to sit down with the accountants and look at all the scenarios and then cross compare. That, like when you've got it in your own name, there's going to be one painful point, whether that's exiting with some capital gains, whether that's capping yourself at a low rate income. So you've got to be creative the way you live. There's going to be one trade-off. You've got to look at what trade-off you can live with the most and then go with that one, kind of thing.
Yeah, absolutely. I think one of the key metrics in any of the strategies, if you're owning the asset, is to try and own it for as long as possible. I will die with all my properties because it removes a lot of the risk, because we know property goes up long term. Guaranteed. In the next 30 years, it'll be worth a lot more, whether it's due to inflation or just because there's a lot more demand for it. So when you're investing through a limited company and you're planning on holding on to it, it makes those decisions with those personal properties easier because you know it's a temporary pain. But in 2 or 3 years' time, that capital will be working a lot harder for you in the company for the next decade or two.
Good point. Okay, for the next question. How will business tenancy contracts be affected by the Renters Reform Act?
I guess we mean like commercial property like leases. I'm assuming that's what we're sort of referring to. One of the things I like about commercial at the minute, a lot of the strategies that I do, look, service accommodation, you don't have tenants, you have guests, so that's great. If you're really worried about having tenants, HMO, if you've got 6 people in the property, God forbid if one of them stop paying, you are still making profit. And then commercial property, if you've got the contract drawn up correctly, the renters reform doesn't affect it at all. It's completely separate. So you don't have tenants in the AST sense. So if, for example, someone didn't pay and you got your agreement set up correctly, you can have them out of their property within 21 days. It's not the whole elongated court process that you get with tenancies, the horror stories that you hear. Commercial property, you can take larger deposits, 3 months, 6 months. You can set longer contract terms, 10 years. You can have FRIs. So there's a lot more that you can do in that. That's why I'm leaning more into commercial than ever before. I'm not just saying do commercial, not resi. I'm saying do both. Really, I think once you've mastered one, do both. Don't do one, then the other, then the other, then the other. Master one, do both, spread it. But no, look, the long and the short, if that's which I assume that's what you're referring to, it's not really, it's unaffected. If we're just talking about commercial tenants in commercial properties, that's a separate matter altogether because it's not someone's primary residence, so they're not afforded the same protection as a residential tenant.
And Steve, there is a question for you, like perhaps related from Lisa. Mixed-use properties treated as fully commercial. I don't know if it's a question or a comment in all aspects, even if it included residential flats above shop. Yeah, I think it's a question, no? Because mixed use basically, usually we can describe it, it will be like a shop or some kind of a commercial property, and then usually on the top you'll have some flats or things like that, yeah?
Yeah, I'm assuming, Lisa, that because I referenced the stamp duty, so I'm assuming that might be in reference to the stamp duty. I'm not 100% sure because there's lots of different aspects, right? You've got lending. So my lenders are deeming that to be semi-commercial. So one a bit of both, it's semi-commercial. Then you've got the tax aspect. The income is treated differently from residential to the income from commercial. And so, I mean, that's more of an accounting matter. But as far as stamp duty goes, which is the bit I was referring to, and I think that question may be in relation to, but do clarify, Lisa, if it's not, is that you pay non-residential stamp duties for the entire purchase. One thing, warning, that has been discussed by a government think tank somewhere not that long ago was charging residential rates for the residential aspect and charging commercial rates or non-residential rates for the commercial aspect. As it currently stands, there's a massive opportunity for, I mean, I'll give you an example. I bought a Greg's sausage rolls, the type of thing. £170,000 purchase, £400 stamp duty. I mean, if you compare that to residential stamp duty, it's worlds apart. So mixed use, as it currently stands, falls under non-resi. Non-resi is 0% up to 150,000, 2% 150 to 250, and then 5% over. It will always be less than additional rate unless you've got a stamp duty relief available, because additional rate's 5% plus whatever the effective rate is, right? So the stamp duty, which I think that might be referring to, is same as any other commercial property. Other aspects are treated differently. The income isn't vatable. It's the same as any other residential income, really.
See, now I realized, are you standing?
Yeah, I am, yeah.
Oh, nice. It's impressive.
Wait, hold on. Are you sitting?
Huh? Of course.
You guys sit? You guys all sitting?
I
No, I'm
think so.
just kidding. No, I'm just kidding. I'm always standing ever.
Yeah, nice. Okay. No, you can look at it like it's standing. All right. Thoughts on commercial to residential conversions? Question from Tony. I think it was very popular, like, I don't know, 2 years ago. Commercial.
Oh, okay, commercial to resi. Sorry, I've just seen it. Commercial to resi conversions. Yeah, if you know what you do, this actually ties a bit with Harvey, what Harvey said, right? So commercial to resi, you won't see me pumping much rhetoric around commercial to resi online because it's beyond the scope of most people's capabilities. It's a big
Planning
deals.
permission as well, no? You need planning permission or PDs or
Potentially, you can do a lot of it under PD, so unless there's an Article 4 restriction on conversions in the area, but you can convert a lot of commercials under PD. That there is an opportunity there. I'm not going to say there's not, but in that case, yeah, there's potential planning nuances, there's potential development nuances, there's some great tax reliefs associated, and some potential uplift. Right now, I think it depends on your exit. Are you going to convert and hold? Larger developments, probably not. Converting and selling right now in this market, I wouldn't recommend. And so I just think it's not one that's I've gone in and weighed it up quite a few times. It's not one that's ever appealed to me personally. So I only ever publicly talk about the things that I personally do. And one of the reasons is, although there's scope to make money, there's scope to lose money as well. And I wouldn't want to be at the end of, let's say, I converted I don't know, an office block into 12 flats and now I'm trying to sell the flats. And I've seen this many times and now I'm stuck on them. Or I could sell 5 and I'm stuck on 7 and I've got expensive lending. So I'm personally less inclined, but I'm not saying it doesn't work. So that's where I'd leave it. I'm not inclined towards it. I think there's enough things that are more straightforward that I prefer.
Coming back to what Harvey and what Steve said, it's about knowing your skill level. So the triangle really is capital, time, and skill. I am not a builder. I have used deal sources for every single one of my purchases. Driving around, and these are simple purchases, these are not massive conversions, because again, what Steve said, you don't want that downside if you're not a professional. You're okay taking the risk if you have nullified pretty much every risk factor there. And when it comes to conversions, there's so many things outside of your control. It's too risky unless you've done it a lot. And the people who do that successfully will have a portfolio of HMOs, or they will have a portfolio of buy-to-lets. They will have a trading service accommodation business that is just funneling the cash into the larger, riskier projects. But it's almost like a hierarchy of you get to here once you've built your foundation. And a lot of the conversations I have with people who want to get involved in property, they've got a lot of cash and they think they can bypass the time in property and just jump straight to, oh, I'm going to do this conversion. It doesn't work. You need to pay your dues. There's a 10-year cost on everything. And that definitely works, but for a very few select people who have built up the experience. So understanding where you are skill-wise is the biggest detriment to a lot of investors, in my opinion.
I think it's a difficult. I mean, I know a lot of experience because you said even with the experience, but I know a lot of experienced developers right now that are struggling on developments. You know, just the cost of materials, the difficulty in exiting. It's just not where I'd want to be. But I agree, the skills, and also just market, right? Market sentiment. Going back to what we said before.
Yeah, do you know what as well? It's a time so I'm going to stand up because I feel lazy now.
We got in his head, or I got in his head. It's working. Go on, Harvey.
But time site, what you got to think is the cycle of the completion of a deal on a commercial conversion of developments is so long and so much can happen in the markets in between. So unless you've got a really good foundation to support you if the things do go down, the bigger the rewards, often the bigger the risks that are associated with them, and you've got to be able to weather that risk if it does turn up one day. So yeah, it's not for the faint-hearted, I don't think. But there is money in them, but it's not nothing I gravitate towards either.
Yeah, I've gone back and thought. Helen, my partner, and I, we looked at it quite deeply a few years back, and we just drew a line under it and said, "Do you know what? That the too long cycle time, too much risk, not for us." Cool.
Yeah.
Should probably jump onto another
Look,
one.
we are running out of time, and we have like 22 more questions. So if you are willing to stay and answer, we can do it.
I'd love to.
Yeah.
Aviram, do you mind if I potentially, because I think quite a few people.
I know what you are going to say. I think.
What am I going to say?
So if not, I wanted like to do like a short stop, and each one of you can just share the links or share like the things that you do right now these days. So if people want to approach you or get more from your programs or your advice and things like that, I think this is the time. So if you can take this what you want to say or not?
All right, fine. Well, it was a lucky guess. It was a lucky guess. I'm giving it as a lucky guess. But yes, that was what I was going to say. Just purely because we're naturally going to run out of time. We're going to do our best to quick fire a load of answers, but people might have more questions. It's hard to become a property investor in 1 hour, right? So if anyone wanted to come along, I do run a lot of free webinars. We do talk about the strategies that we do, exactly how we do them. The next one I got is actually tomorrow evening. No rest for the wicked, of course. So since Avaram's given me the green light to go ahead, if anyone did want to come along to that webinar, I'll pop the link in. I think a lot of people here, I'm seeing a lot of familiar names, have done some training with me in the past. As a quick survey, just pop a one in the chat box if you've already been on some sort of training with me at some point in the past. If we've, I'm seeing familiar names. If it, well, looks like you can't get enough. It's great to see you all in the past. And if you come back again, I'm guessing it was good enough for you to come back again. If you haven't already and you'd like to hear a bit about how we do HMOs, short-term lets, how we add value to properties, how we do our rent-to-rent deal packaging, whether you're just starting out or you've been in for years on end, then I'll pop a link in the chat box. I've got a webinar coming up tomorrow evening. It's completely free of charge. He says he'll pop a link in the chat box, but it's not actually going in. So I'll pop a link in the chat box shortly, and it will be a pleasure and an honor to have an opportunity to support you guys on your journey. I'll hand over the mic now because I see people.
You will put the link to register, Steve. You will put it on the chat.
I will do as soon as I figure out how to.
Okay. So Harvey, feel free to share from your side. You're on mute, Harvey. Harvey, you're on mute.
Yeah, same as Steve. I do free online workshops. I've got a workshop about how to find property deals with AI. My philosophy is every strategy starts with finding property deals, and I've been working out an AI tool that helps you with that. And if you want to learn how to use AI in your property business and leverage that, I run a workshop every Sunday. So I've got one this Sunday. I'll pop the link in the description in a minute. I'll go and find it and pop that in now.
Great. And John?
Yes, if you want to pay as less tax as you legally can, I can help you with that. We are property investors. We're always buying property. The company is called Noble One Accountants, and everybody works directly with me and my business partner. So the way we're set up is we're really personal. We work with you to show you how to use your capital or your expertise or time to build the life you want through cash flowing assets. So I'll put my email in the chats now, and also my Instagram. It sounds a bit strange, but it's king_nobes. It's been like that for 2 decades. People buy from people. Lots of property and life stuff on there if you want to follow me there.
Yeah, great channels for all of you. I think like if you can share the channels, I think great content being published every day. So yeah, so everyone highly recommended to follow those guys.
I can only recommend, this is, John and I quite close. He's very strong, by the way. We've been to gym quite a few times. Clearly a numbers man, lifts heavy weights. I can only recommend that you get on to John now before HMRC get hold of him. That's all I'm going to say. Because when the HMRC get hold of him, it's all done. This is our window of opportunity, guys, to work with him.
Because I save people so much tax, I don't break rules.
Yes. He did very clearly specify pay as little tax as you legally can. He did say legally.
Yeah.
All right, good stuff. So
anybody wants to ask any questions, you can who I missed, you can ask me. Instagram's the best place to ask questions. That said, somebody did ask a question around how does AI work. I just bought a property using AI in an area I've never visited before, and I documented the whole thing on YouTube. I use Lendlord with it. So Lendlord is an AI tool. So I use Lendlord along the way. That video should be dropping, I think it should be either this Friday or next Friday. If you go to my YouTube, you'll see exactly how I used the whole process to buy a property I didn't know, in an area I didn't know anything about. I've never visited before. I've got no connections in there. So, and if you want to ask me questions, jump onto Instagram and ask. Or that webinar on the weekend is a live Q&A as well, which I run myself. So you're more than welcome to come along to that.
okay, good. I will also answer. There was one question about AI because it will connect to what you said. So Lendlord, as I mentioned, is a software that AI is integrated into the software. Let me share the screen quickly. You have this icon on the top right side, which is Lendlord AI, and you can do many things. It's really based on the page you are in, but you can summarize existing properties or your portfolio, or even like get some statistics about postcodes. You can phrase emails, compare two different properties that you own. You can learn on few things, and you can also query your account. For instance, I want to see what was my net cash flow in July 2023, and which property was the best performing property. So you can also do it with the Lendlord AI. And when you analyze these, or when you source these on Lendlord, you have this button on each listing, summarize with AI. So when you click on it, Lendlord AI will take all the information, analyze it, and summarize this listing for you, and you can do follow-up questions. You can also use the add web data to get more insights from the web. It enriches the bot and basically get more accurate questions. And as I mentioned, we also added now the estimated with refurb costs with AI and more. And you have the benefit during this webinar time to get the premium plan, which give you like premium will give you limited access to Lendlord AI. Premium Plus, unlimited access. So just put the coupon code panel26 apply coupon, and you will get it for 50% off both plans. So hurry up and do it. And let's pick some questions. Because we're running out of time, perhaps if you can scroll the chat, John, Harvey, and Steve, and perhaps each of you just pick the question that is more relevant to you, and perhaps you can read the question and answer it.
Sure. Let me just scroll
Just
up.
scrolling up. I think I've ruined the chat, sorry, by getting people to put in one. But thanks, guys. Also, I saw your comment, Karen.
Somebody said, essentially, should you be using a generalist accountant? There is 22,000 pages of tax law. Okay. You can only be an expert in one, maybe two, but I still think just one thing. So if the person isn't doing what you're doing, they're not going to know all of the tax benefits of claiming interest, capital allowances on certain commercial properties, when to be VAT registered, if you should be VAT registered, how are you funding properties? Are you keeping your capital in the corporate ecosystem to pay very little personal tax? All of those things are very property related. So you need to be using a property accountant. That was for Lisa.
Good advice. Harvey, you have a question?
I can go if you're still running.
Yeah, go for it, Steve. Yeah, I was having a little scroll through.
There's
Sorry.
a couple of similar, so I'm going to try and hit a couple of similar, and it ties in a little bit with one that was asked. There's one about social housing earlier. There's one about renting to guaranteed rent companies. There's one about resi to C2 for learning disability. Interesting point, actually. A lot of learning disability or supported living type homes actually fall under C3B. Top tip, because I go for a lot of planning apps. C2 would be care when you're actually physically hands-on giving care. But a lot of learning difficulties or supported living actually fall under C3B, which means a lot of them don't require any planning permission at all. But that's not what I was going to say. These are all very similar strategies. And the concept is you get a house, you give it to someone for a fixed period of time. The reason I hesitated earlier and didn't answer it, but I might as well be transparent. It's not a strategy I'm a particular fan of. I like to have control of the property. I think what was it, John or Harvey answered and basically said, they could give you the property back in a couple of months in a lot of those agreements. I think a lot of them appear on the surface a lot more robust than what they are. And having been around in the game for a while, I've seen some of those unravel, and a lot of the FRIs aren't really FRIs. People have had properties that have not come back in the right way, or I'm less of a fan of that. I'm much more of a fan of, if I'm doing an HMO, I vet the tenants. A lot of them are also less this is more the social housing side, less open about who's really going into your property. That can create not just damage to the property, but havoc with the neighbours, which can put other external pressure onto you. I'm not a big fan. Learning difficulties, supported living, great in the sense of a very wholesome thing to do. They will generally pay higher rents. Be aware that in that scenario, your lending, speaking as someone who owns a finance brokerage, is generally going to be higher. You just be mindful which operators you put in. The actual money in supported living is in supported living. That's why they pay the elevated rents. My best friend is very heavily into supported living. He's got 4,000 employees and a massive business that is largely based on supported living. They will pay elevated rents because they generate so much. If you are interested in that, I challenge you to explore the operational side, because that's where actually the big money, the real side money's made. There are a lot of people out there that are trying to get into supported living as operators that aren't experienced and will want to take on your property and might present themselves as experienced. So just be mindful of that. Do your due diligence on a company if you're going to take them in. Again, I'm not a massive fan. I understand why people gravitate towards it. My preference is the things that you've got control over. So I understand that it just seems tempting, right? We'll take the property 5 years. We'll give you guaranteed rent. That's all good while their business is good, but it's like the employee myth, right? I'm safe because I've got the job, and my job's safe and secure. But actually, you're now basing your future on your employer being able to run their business well. You're now basing your rent on this person operating their business well. I'm a bit of a control freak. I'd prefer to keep control of the property, and so not one for me. But I understand why people do it. If you are going to do it, do your due diligence, find out who is going in the property, how that property is operated, how long that operator's been going for, how many properties they currently have. And then I would go as far as to get feedback from someone they are currently working with right now. And if they won't provide that, there's probably a reason why.
Yeah, good stuff, Harvey.
Okay, so there's a question in there around AI in property. What is it? There's a longer question with it, but I don't fully understand the question, so apologies on that. But AI in property is just being efficient using AI technology. Lendlord's an AI technology. Lavram says about Lendlord with like the AI feature that it's got in there asking questions, but the whole thing, the digital broker in there, just AI. Instead of phoning a broker would go through a spreadsheet manually before. This is artificial intelligence. But you get generative artificial intelligence, and you get like sort of hard intelligence that kind of you direct, but it's just getting better and better. So what it is in property, how we're using it at the moment in property is specifically at the moment we're doing direct to vendor leads, and we're getting AI to chat with them and qualify those deals as they come in. We're gathering the information from them. Then when we're using AI in the background to analyze the deals in the background, it's not perfect, but it gives us enough information to understand whether or not it's worth spending more time on. If you put an ad spend behind this, you'll get hundreds of leads in place. And wherever you don't, even if you're phoning up agents and looking on Rightmove, the way you get really, really good property deals, if you look at volume, volume negates luck. So you want to look at high volume of deals, but it takes time and effort to go through that high volume. So if you can utilize even online stuff, you can get AI agents that can scrape them offline, put them into a system like it was typical the CRM. You can trigger events in the background of the system, which will then give you information on the property that tells you, is this worth phoning up or is it not worth phoning up? It's like if you went out to buy a new car, you might not take your mechanic with you with his plug-in kit because it costs hundreds of pounds to assess it, but you'd open the lid of the bonnet and you'd look for oil signs and smoke or rattling sounds, using AI at the front end to assess as many deals as you can, and then kind of give you that go ahead. Is like just opening the bonnet before you spend money or time on taking mechanics. So it can work across all elements of your business as well. Anything you can do online, AI is assisting with that. It doesn't do it fully at the moment, but it's getting better and better and better. And my thoughts is I would be leaning into it now and learning and leaning into it and growing with it as it's getting better and better. Because as I said, I think we've got a window of opportunity where that wealth gap is just going to divide it even wider, and it's going to get harder to hop from that side across to the other side. So, but I think the opportunity at the moment is absolutely vast. It's really, really big and very exciting.
I just want to repeat something that Harvey casually dropped in that made me smile, which is such a golden nugget. It's only 3 words, but we use it in our business so much. Volume negates luck. And that's what the AI side is, right? It's allowing you efficient. I'm half German, so I love efficiency. It's allowing you the efficiency to analyze a hell of a lot of deals. But what a quote, volume negates it. We say that so much in house. It's just nice. I'm just going to highlight that. If everyone just takes that away, the more deals you analyze, the more you were taking luck out of the equation. And obviously the tools that help you do that are golden. And this is the era where people that are early adopters and jump onto these sorts of tools will thrive. I do agree wholeheartedly.
Yeah, absolutely.
To that, because of that.
Volume and repetition, by the way. Like the people keep high volume because it's like anything. If you go to the gym consistently for a long period of time, you will get results, you know, like it's the people that stay inconsistent. So yeah, that's my last thought.
Just wanted to add to that if you want to analyze deals at scale, you need to use the Lendlord.com extension. So I will put it on the chat. It's just you can download it or from the Chrome web store, and then as I demonstrated before, on any Rightmove, Zoopla, on the market deal, just click on the Lendlord deal analyzer. Just select the strategy you want to analyze, and you will get all the numbers on our deal analyzer, and you can play with the scenarios and make better decisions at scale. We also extract the information, and we've added to the new deal analyzer sections for the property specs, comparables, also a summary. This wasn't the greatest deal for me, but yeah, I can play with the numbers now. Let's wrap it up and summarize this great webinar. I really enjoyed it, and I wanted to I want to thank Harvey, John, and Steve for joining us. Hopefully, we can do more webinars this year in the next few months together. You have the contact details of everyone. I also shared a link tree of Lendlord team if you want to schedule calls. We also run a promotion during January for bridging finance, digital bridging finance. You can apply to the system, free valuation until the end of January. So if you are purchasing our property in auction or you need to perform some refurbishments, we also cover the refurbishment costs. We can go higher as 90% of the purchase price, capped by 75% of the market value. And we also do a presentation on legal, which can speed up the process. So highly recommended to try it. You have it on the link tree that I shared. You can apply online or from your Lendlord account. So final words, Harvey, John, and Steve, and we'll say goodbye, and we'll see you in the next webinar. But feel free to say goodbye, and perhaps you just summarize it from your side.
Sure. Firstly, it's a pleasure to be here and share the stage with you guys, and thank you for everybody who is here listening. Avoid the noise. There's always going to be fear, uncertainty, doubt. It's attractive. It's rubbish. Ignore it. Look at the numbers, invest in a property, hold on to it, build your cash flow, keep going. It's guaranteed. It takes a little while. Once you get to critical mass and you've got that cash flow there, it changes your life and your family's life. So yeah, and incorporate your family as much as possible. It's super tax efficient. That's my exit.
Yeah, I think I'll leave my exit in words on I was before. Volume and repetition negates luck. You know, you just like it's probably going to be harder than you think. It's going to take longer than you think. So, like the 10x rule book, I wasn't a fan of Grant Cardone when I first see him because he was a bit too brash, from my opinion. But everybody liked him who was in my circles at the time. So I read his book without listening to him. And the principle behind that, it's going to be 10 times harder and it's going to take 10 times longer. So if you do 10 times the effort of what you originally thought you was going to do and stay consistent with that, you probably get the results that you thought you was going to get. But yeah, just keep going, keep on keeping on. Volume negates luck and repetition. So good luck with it this year. And definitely lean into AI. That's my final thought. I think if you don't lean into AI, you are going to get left behind.
Awesome. It's hard when you're last, isn't it? I think technology, AI, I always like to repeat golden nuggets and look, all joking aside, what Lendlord offers in terms of AI is unbelievable value. I don't know how Avram does it, but he does it. So thank you for doing it. John, people like John are changing the game. It's not just about what you make, it's about what you keep. And that's more important now than ever. So do make sure you follow people like John, that you get an accountant that understands property. Was it 22,000 pages? That's a strong read. I doubt your accountants read it. And if they have read every page, I doubt they remember it. So it is critical that you do that. I'm only going to say one thing to keep it simple. And I'm just going to piggyback on what Harvey was saying. before Aviram shared the deal analyzer, which is about consistency. I'm massive on consistency. I think that there's a lot of massive action talk and everyone has to take massive action, massive action. And that's all about intensity. And it's great at the beginning of the year when everything's super intense and you feel like you can take on the world. But I think it's more important to be consistent than intense. I think consistency beats intensity every single day of the week. So I always say to people, make sure you're doing something every single day, even if it's small, that's taking you towards that life that you want to live. And so consistency is key. You hear these things, but they really mean something. It's not about, taking over the world in a day. That's unrealistic. But if you do something every single day this year, your life could be entirely different next year. It could be, and in fact, I'm not even going to carry on because Avram's going to tell me off. Consistency.
No, I won't. But yeah, great tip as always to summarize this webinar. So thanks again. Thanks, Harvey, John. John, it was a pleasure to our first webinar, and hopefully,
Yeah.
John, we can do perhaps we can do like a dedicated webinar, perhaps in the future on just on tax. But happy to have you here today. And thanks, Steve. So thanks
You're
everyone.
welcome.
The recording will be on
Take
our
care,
YouTube
guys.
channel. And I shared the link on the chat. So have a great evening and see you in the next webinar. Thanks everyone and good night.
Take care. Good evening.
Take care.